Very good morning to all. I hope you are doing great. I am also good. Very warm welcome to my YouTube channel. My name is Dr. Reena and I am so happy to have you here. In today's video, we are going to talk about these topics: capital structure, its theories, cost of capital, sources of capital, and finance. So let's understand these topics thoroughly one by one. Before understanding these topics, let's understand this thing why we need to study these topics like capital structure, theories, cost of capital, sources, and finance. By studying capital structure, theories, cost of capital, sources, and finance is essential for making informed financial decisions that optimize a company's profitability, risk, and overall value. A well planned capital structure ensures an optimal mix of debt and equity, minimizing the cost of capital while maximizing shareholder wealth. Understanding capital structure theories helps businesses to develop strategies for financing growth while managing financial risk effectively. Knowledge of cost of capital aids in investment decision making, and it also ensuring project generate the most stable funding option for sustainability and expansion. These concepts are crucial for investors, financial analysis managers, and entrepreneurs to ensure financial stability and long-term success. So let's understand these topics thoroughly one by one. So first topic we have capital structure. Basically, capital structure is critical financial decision for any business as it determines the mix of debt and equity financing that a company uses to fund its operations and growth. The choice of capital structure impacts the firm's risk, cost of capital, profitability, and shareholder values. A well defined capital structure helps a company minimize its cost of capital while maximizing shareholder wealth. It includes various sources of finance, such as equity, debt, and hybrid securities. Theories of capital structure guide businesses in making optimal financing decisions. So, these are the theories. First, so let's understand these theories one by one. First theory we have net income approach, which we can call it NI approach. Second approach we have net operating income approach, that we can call it NOI approach. Third approach we have traditional approach, which we can call it intermediate approach. And the fourth approach is Modigliani and Miller theorem. So let's understand these one by one. Okay, basically, various theories have been proposed to explain how firms determine their capital structure, and these include different theories. So, first theory we have net income approach, and this theory is given by David. This approach suggests that a company can increase its value by using more debt. Okay, in the NI case we have to use more debt, and these are the assumptions based on NI approach. First assumption we have: debt has lower cost than equity. Apart from that, there is no financial distress due to excessive borrowing. As debt increases, the overall cost of capital decreases, and these are the implications based on NI approach, that means net income approach. Firms should maximize debt to reduce the overall cost of capital and increase firm value. Second approach we have net operating income, which we can call it NOI approach. It is proposed by David. This theory argues that capital structure does not impact a firm value, and these are the assumptions based on net operating income approach. So first assumption we have: the market values the firm based on its operating income, not its financing mix. Apart from that, the most of the equity increases with higher debt to compensate for higher risk. And these are the implications based on this approach. There is no optimal capital structure. Firm should focus on business operations instead of financing decision. Okay, so in the net operating income, business should have focus on business operations instead of financing decisions. Third approach, we have traditional approach, which we can call it intermediate approach. This approach takes a middle ground view, combining element of both NI and NOI approach. NI approach, that means net income approach, and net operating income approach. These are the key ideas behind the traditional approach. A moderate level of debt can reduce the overall cost of capital, and too much debt increases financial risk, raising the cost of equity and total cost or total capital. And these are the implications based on traditional approach. There is an optimal debt equity mix where the firm maximizes its value. Next, we have Modigliani and Miller theorem. Basically, Franco, Modigliani and Miller proposed this theory with two cases. First one is without taxes, second case is with taxes. In case of taxes, since interest on debt is tax deductible, firm should use more debt to benefit from tax shield. And without taxes, in that case, capital structure is irrelevant. Firm value remains the same regardless of financing choices. And this is the criticism of theorem. That means Modigliani and Miller approach. First criticism is it assumes perfect capital market and it ignores the bankruptcy cost and agency problem. Next topic, we have cost of capital. Cost of capital refers to the minimum return a firm must earn on its investment to maintain its market value and attract investors. These are the types of cost of capital: cost of debt, cost of equity, cost of preferred stock. So let's understand these types one by one. In case of cost of debt, it is represented with KD, cost of debt, and the interest rate paid on borrowed fund, and this is the formula of cost of debt. KD is equal to interest rate into 1 minus tax rate, and cost of equity is represented by KE, the return required by equity investors, and this is the formula using this dividend discount model. KE is equal to D1 divided by P0 plus G, where D1 is expected dividend and P0 is current stock and G is the growth rate. Third, we have the cost of preferred stock, which we can call it KP. That means fixed return required by preferred shareholder, and this is the formula of this one: preferred dividend divided by market price of preferred stock. Next, we have weighted average cost of capital, that is represented with WACC. The overall cost of capital considering all sources of financing formula, and this is the formula: WACC is equal to VEV into KE plus DYV into KD into 1 minus tax rate. Here E is the equity, D is the debt, and V is the total capital. Next, we have the sources of finance. Basically, the companies can finance their operations through internal and external sources. And internal resources, which include the retained earning, depreciation fund, reserve, and surplus. In case of returned earning, where profit reinvested into the business instead of being distributed as dividend. And in case of depreciation fund, non-cash expenses set aside for reinvestment. And in case of reserve and surplus, it is accumulated profits used for expansion. In case of external sources, where equity finances include common shares, preferred shares, and debt financing. So let's understand this one. Equity financing, which include the common share and preferred share. In case of common share, investor become owner and receive dividend. In case of preferred shares, fixed dividend payment with priority over common shareholder. Next, we have debt financing, hybrid financing, venture capital, and crowdfunding. Next topic, we have capital structure and finance. Capital structure decision affect a company risk, cost of capital, and overall value. And these are the factors influencing capital structure. First factor, we have business risk, cost of capital, tax benefit, control consideration, growth opportunities, market conditions. Next topic, we have optimal capital structure and the best mix of debt and equity that minimizes the cost of capital and maximizes firm value. Come to the conclusion of these topics. Basically, capital structure is a vital financial decision that influences a firm's profitability and long-term sustainability. Theories like traditional NI and NOI provide insight into financing decision. Understanding cost of capital help the firms to maintain a balance between risk and return. Companies must consider various sources of finance to create an optimal capital structure. So these are the multiple choice questions based on these topics that we already discussed in the previous slides. So first question, we have the theory that suggests capital structure is irrelevant is proposed by, and the right answer is B, Modigliani and Miller. Next question, we have the formula of weighted average cost of capital includes all of the above: cost of debt, cost of equity, tax rate, all of the above. And the third question, we have the cost of retained earning is equal to cost of debt, cost of equity, cost of preference capital, and zero. So right answer is cost of equity. Next question, we have the debt equity ratio is used to measure the leverage. And next question, we have which of the following is not an internal source of financing. So bank loan is not the source of finance in case of internal. Next question, we have interest on debt financing is beneficial because it is tax deductible. The relationship between capital structure and cost of capital is explained in capital structure theories. Next question, we have Modigliani and Miller theory assumes no taxes in the company, no bankruptcy, and perfect capital market, and all of the above. Next question, we have which of the following sources of finance has ownership dilution, and the right answer is A, equity shares. Next question, we have the cost of capital is also known as opportunity cost of capital. And the next question, we have the proportion of debt and equity in firm's capital is called capital structure. Which type of financing involved borrowing money with the promise to repay? And the right answer is B, debt financing. Next question, we have which of the following has the lowest cost of capital? And the right answer is C, debt. High financial leverage indicates, and the right answer is high debt component. Next question, we have what is the main disadvantage of equity financing? And the right answer is B, ownership dilution. Next question, we have the net operating income approach assumes, and the right answer is C, capital structure is irrelevant. And the next question, we have the preference shares have, And the right answer is fixed dividend. Next question we have, the major benefit of using debt financing is lower cost due to tax saving. Next question we have, hybrid financing include convertible venture. And the next question we have, the primary objective of capital structure decision is maximizing firm value. So that is all about for the today's video. Thank you so much. If you like this video, then do like and subscribe my YouTube channel. Have a nice day. Take care. Keep learning, keep growing, keep signing.